then what will happen to the net present value if the useful life of the machine decreases? So we know that the machine has a useful life of 10 years. So what if that is less? What if it only has a useful life of 8 years? That means that Furniture Galore is going to be able to use the machine for a shorter period of time to manufacture this custom-made luxury furniture, which means they'll be able to sell less furniture. So they'll have less income, which will cause the net present value to decrease. What's happening is, if the machine has a useful life of 10 years, they've got 10 years to make income from that machine and to recover the cost of that machine. If it drops, they have to recover the cost in less time. And they're obviously going to lose out on the income that they'll make. Let's say, for example, it drops to 8 years. They're going to lose out on the income that they could have made on the sale of furniture in year 9 and year 10. So that would cause the net present value to decrease. Okay, so it will decrease the amount of time available to earn revenue to recover the initial machine cost. So that one's a bit easier at least. Then what happens if the discount rate decreases? So in my last example with you guys, when I was discussing the SARS allowance, I used a discount rate over there of 10%. Now remember, the discount rate is the minimum return that the company needs from that project. If we have a discount rate of 10% and we calculate a positive net present value, it means that the project or the investment is going to give a return higher than 10%. So 10% is the minimum return that we want. So if the discount rate decreases, it means the minimum return that the company wants decreases, which means the net present value is going to increase because they want a smaller return to break even. So that would cause the net present value to increase. I'll look at the factors over here with you as well, just so that you understand the time value of money impact. But it decreases the rate of return that is required for the project to be profitable, which will cause the net present value to increase. Or what you could have said as an alternative is it has a smaller discounting or time value of money effect. So again, let's just jump to that table so I can compare two different discount rates with you and you can see what I'm talking about over here. All right, so you can see over here, I have the discount rate of 10%, which we were working with previously, and I've also just added a discount rate of 8% so that you can see the difference between the present value factors. Now you can see with a lower discount rate, so if the discount rate decreases, these present value factors over here are higher, which means you're taking your cash flows over here in all of the years and you're multiplying by a higher factor, which is going to cause the net present value to increase. So a lower discount rate means that they require a lower return from the project. And if they require a lower return from the project, the NPV will increase because you can see your present value factors over here are going to increase. All right, so that deals with the first part. There's just one more thing that you needed to discuss over here, guys, which you should have picked up. Because of the fact that the cost of the machine might change. If the rand deteriorates, obviously we said the cost of the machine would increase, and that would obviously have an effect on the depreciation charge every year. In addition to that, if the useful life of the machine changes, this point over here, that would obviously also affect the depreciation expense every year. So it's important to note, currently we know the machine is going to be depreciated over its useful life of 10 years. If the useful life changes, then obviously the depreciation amount every year will change. Also, if the cost of the machine changes because the rand deteriorates, then obviously the depreciation amount every year will change. However, it's important to note that this will not have any impact on the net present value, because remember, depreciation is not a cash flow, so it's not included in the NPV analysis. We only include cash flows in the NPV analysis. More specifically, future cash flows that directly relate to the project. So even though some of these changes over here might affect the annual depreciation expense, it will not affect the net present value because of the fact that it's not a cash flow. So there's one mark available just for discussing that over there. So it's important to note that depreciation is not a cash flow and is therefore not included in the NPV analysis. So any change in the annual depreciation charge, so if the cost of the machine increases because the rand deteriorates, so that will obviously affect the depreciation expense, or if the useful life of the machine changes, sorry guys, that should say decrease, I'm going to correct it in the solution. You'll see it's corrected in yours. I'm going to correct it directly after this. So if the useful life of the machine decreases, that will obviously also affect the annual depreciation expense. But because depreciation is not a cash flow and it's not included in the NPV analysis, this will not have any impact on the NPV analysis. All right, so that's also important to note. Then let's just go back to the required again, because we still haven't finished part B of the required. In part 2, you need to explain how a forward exchange contract or an FEC can be used to hedge currency risk. You should make use of the quoted rates provided in your answer, but calculations are not required. Okay, so let's go back to the information here. Of the possible changes listed above, the managing director's biggest concern is that the rand is going to deteriorate over the next 90 days. So he would like to understand how an FEC can be used to hedge this risk, and he did some research and found the following rates. All right, so you can see he's been given the forward rate for 90 days because that's obviously when they need to make payments. So he's worried that the exchange rate is going to deteriorate over the next 90 days. Now, it's important to note you've been given two rates, the bank's selling rate and the bank's buying rate. So you're going to need to know which rate to use in your discussion. But before we get to that, let's just discuss what an FEC is, guys. An FEC is a binding contract, which means that both parties have to perform. So it's not like an option, for example, where if the exchange rate doesn't move the way you predicted, you can say, I'm not going to exercise the option because it's not in my best interest to exercise it. That's not how an FEC works. It's a binding contract. And what happens is at transaction date, the exchange rate for the future is fixed. So what the managing director can do, the managing director of Furniture Galore, he can go to his bank and he can enter into an FEC contract with his bank. But he must understand it is a binding contract. And he enters into a contract to buy foreign currency at a future date. But the amount that he's going to buy that foreign currency at is fixed today. So he's not going to be exposed to any currency risk at all because he knows today exactly what the amount is going to be or exactly what the exchange rate is going to be. They fix the exchange rate today when they enter into that contract. So any uncertainty about what's going to happen with the rand is eliminated and he's not exposed to any risk. He knows today what the exchange rate is going to be and therefore what this machine is going to cost him. So he can use this FEC to eliminate currency risk. All right, but we do need to know which rate he should be using over here. You've got the bank's buying rate, which I said to you, that's the rate that they will buy foreign currency at. So if you've got pounds and you want to sell it to the bank, they will buy those pounds for 20 Rand and 26 cents. However, if you need to buy pounds, the bank will sell those pounds to you at 20.85. Okay, that's obviously how they make their profits. It's the difference between the two. So what rate should we be using? Furniture Galore is a South African company, so they obviously have access to rands. But they are buying a machine from the UK. So they need pounds to be able to pay for that machine. So they are going to have to go to their bank and take rands and ask the bank to give them pounds. So the bank is going to be selling pounds to Furniture Galore. So you need to use the bank's selling rate. Remember, we look at it from the bank's perspective, not from Furniture Galore's perspective. What is the bank doing? The bank is going to be selling pounds to Furniture Galore. Furniture Galore will be buying the pounds. Okay, so that's the rate we're going to use. So this is how he can use an FEC to hedge currency risk. He goes to the bank today, he enters into a binding agreement with the bank. And he agrees that in 90 days' time, make sure you use the information provided in the scenario in your solution because that's where the marks are going to come from. They agree that in 90 days' time, the bank will sell them pounds, or Furniture Galore will buy pounds at a rate of 20 Rand and 85 cents. So he's no longer exposed to currency risk. He won't be affected by any fluctuations in exchange rates because they have fixed the exchange rate at transaction date. And then obviously just explain why you are using the selling rate in your discussion and not the bank's buying rate. So what is an FEC and how can they use it to hedge currency risk? Furniture Galore can enter into a binding agreement with their bank to buy foreign currency on a future date, in other words, in 90 days' time, at a specified rate, or in other words, at a rate of 20 Rand and 85 cents. It's important to note that the bank's selling rate is used because Furniture Galore will be purchasing pounds, which means the bank is selling pounds to Furniture Galore. And as a result of this, they won't be affected by fluctuations in exchange rates because the exchange rate is fixed at transaction date. All right, guys, so that's what I was looking for in part B of the required.